we have seen some very concerning, potentially concerning macroeconomic data drop over the last week or two. So that's what we're going to be discussing in tonight's market recap. Let's go ahead and get right on into things. Real quick though, if you're new here, hit subscribe, turn that notification bell on, hit the thumbs up button if you find this video helpful. All right, let's see. A couple things came out over the last week or two, and despite the bad economic data that's come out, markets continue to churn higher. So the real question is kind of what gives at this juncture. But we did see CPI come in much cooler than expected. We did see unemployment come in higher than expected, momentarily kind of shaking markets a little bit. Look, overall, I think there's a very reasonable explanation for what it is we're seeing, and I'm also not concerned at all. So let's dive into what I think is kind of behind the sudden slowdown from a macroeconomic perspective and why ultimately we're not headed to recession land anytime soon. Before I do though, I do want to plug my own website, appliedmmt.com. The team put out a very good article. I wrote this up, posted this right after the July 4th headline, and it's completely free. appliedmmt.com. Just come over, read it. They did a great job kind of looking over a vast amount of macroeconomic data to really kind of piece together the very argument that I'm going to make tonight and kind of show how it shows up across the macro landscape. And that really just is that we've seen a period of kind of what I'm just going to call deficit waning, right? We had, wrong one. There we go. We had a very strong surge in the growth of deficit spending following the 2022 contraction that, as we've explained many times, really allowed markets to surge heading into 2023. The rate hikes massively increased the interest income that hit the private sector, and that boosted things through 2023 and now into 2024. Since mid-2023, and certainly since the kind of beginning part of 2024, we've started to see this waning period where deficits are starting to slow down. I even think April and June both, respectively, were surplus months. We had very strong surpluses already this year, and therefore the overall acceleration is beginning to fall off with deficit spending. Now, in and of itself, this is not a concern until we go full surplus mode in terms of rate of change perspective. We're still seeing deficits grow, and there's no reason to believe that deficits are going to start falling off. But there is always this transition period between a very strong surge in deficit spending, which does two things. Again, something we've really driven home many, many times on this channel. Number one, it starts profit cycle. Those become profits for the private sector, and if you know your Minsky, you know the investment function, the decision for the private sector to increase credit is solely dependent on profits increasing. So it does that. It kicks off the investment cycle. And the other thing it does is it capitalizes the private sector when the government spends. So when the government, when the government spends, and ultimately that spending ends up as bills, notes, bonds, right? That is kind of the capital base that the private sector is going to use as safe assets to leverage from. So it always kicks off a credit cycle because the necessary ingredients are now in the pot in the private sector to allow it to grow. And so you always see this kind of change of tracks, and it takes some time for it to happen. And it's not just a immediate, okay, now we're in the credit cycle is the the main functioning arm. There's it's a dynamical system. A lot can happen at the same time, but we are certainly making this transition into a more credit boom into as we head into now this the second half of 2024. But in the meantime, we did see this kind of waning effect, which I think immediately explains why we see CPI a little bit cooler than expected, and we see unemployment take a brief jump higher. With that being said, like if you look at unemployment and you're really, let's just say you're really on the I still think a recession, there's a chance for a recession relatively soon. Look, we're very far away, and if you look at something like non-farm payrolls, a much better measure here, you would, if we were close to recession, one, we'd see credit crashing, which we're not. Two, we'd be seeing a lot happening. It's just not. But we would also be seeing total non-farm payrolls starting to roll over as well. So what I really think explains what took place, at least with employment, is we just continue to see this kind of bullwhip effect going all the way back to the initial motion, which is the post-COVID period, right? We saw massive expansion following the stimulus in the post-COVID period. That collapsed into 2022, even 2023 a little bit. We saw kind of another knee-jerk reaction after kind of the head fake of 2022, and now we're just calming down just a bit here. But now this bullwhip effect, starting at where its genesis was all the way back at 2020, is probably finally coming to a conclusion. We're going to start to see things moderate a bit here, and the credit cycle is likely going to take off again for the reasons that we have described, which is what government spending is doing to the private sector as a whole. And so let's go ahead and bring that data up. I think we looked at it during the last update, but it continues to accelerate. Bank credit for all commercial banks on the H.8 data series continuing to accelerate. All I mean by accelerate is positive rate of change, and that rate of change pushing higher from the week prior. Same things with loans and leases. And again, you can go across the line item board on the H.8 credit side of their assets, and you'll see that most of these are accelerating, certainly the ones that are going to be most directly related with economic growth. So I'm not concerned at all from a long-term perspective. On the short-term perspective, I think everything I said during the last update remains. We're probably still maybe a little overbought here. Wouldn't surprise me at all if we end up getting kind of a play out, maybe not similar to what we or not too dissimilar to what we saw during this time last year. Maybe a little bit of selling into the beginning of the fall months, but overall, longer term, things are looking pretty darn strong in terms of where we're at with the credit cycle. And a brief shout out to Ben Kizanchuk. Hopefully I got that right. A great thread here. I'll try my best to link it in the description below. A great thread here on just everything credit cycle and all things he's seen that are kind of demonstrating that we are likely headed towards another credit boom. I mention it because he mentions a thread that I had, and overall I think we're all seeing the same thing here from those of us who are taking things from this kind of heterodox MMT perspective. And again, this is what the other implication to this too, and I've been pointing this out for quite a long time. I tried to find some of the older threads that I have just to point out that this is nothing new, but this is really, I don't want to say MMT 101, but this is education of the MMT framework of what government spending does to the credit cycle. And I've been very bullish on the credit cycle here, and I think we're really seeing that come into fruition. And so if that credit cycle takes off, it has, even if for some reason, I don't see this happening, but even if we see deficit spending really fall off a cliff here, I think we could get something like the 2000s or the 90s to play out. Even if we saw, I don't think deficit spending is going to collapse here. I have no reason to believe, but even if we did, I think we are in such a healthy balance sheet shape on the private sector side that we could even carry a surplus from the government side for a period of time, right? So I mean, that's how healthy we are. We're probably not going to get that in terms of deficit spending going negative into a surplus. So I think we're going to really be living in the best of both worlds here, and that's why I'm really not at all concerned longer term in terms of where we're at from a macroeconomic perspective. I think the last thing I want to drive home though with this point is what the implication is for what the Fed is going to do. And certainly at the start of the year, I said my bet was placed on no cuts. Now, because we got some cooler than expected data to come out, we are starting to see the market kind of clamor for cuts by September. July, still no cut expected, but by September, it's looking pretty likely that the Fed will cut. Now, there will be a handful of prints that come out for data that could end up being much hotter than expected and could shake things up, and we've seen that pattern play out at this point for every Fed meeting, where it looks like there will likely be a cut. By the time we get there, there's no cuts. But I do think there might finally be a chance in this September meeting for a cut. It would certainly be the most timely. Maybe there were some political implications to think about in terms of the Fed maybe just saying, okay, we're going to wait until after the election. But it seems like the markets are finally calling for the Fed, or kind of pushing on the Fed to go ahead and make a cut. With that being said, I don't think it's going to change anything, right? And now, look, if somehow the Fed got in 10 cuts by the end of the year or something like that, that might change the overall dynamic here. But what I think could happen, okay, let's say we do get a cut. What's probably going to happen is, now that we're seeing the credit cycle really take off, and again, once the credit cycle starts, what the Fed does is it's just, it doesn't affect the credit cycle. The credit cycle is agnostic, except under certain circumstances, to monetary policy. In fact, before I make my drive home point on what I think is going to happen with the Fed and rates, I would say I think the main critique MMT has of kind of mainstream macro is MMT would say you far overweight and overvalue monetary policy and far undervalue and underrate fiscal policy or the implication of fiscal. And my point point is, are there scenarios where monetary policy can have implications? Yes, but 99% of the time, it's what the fiscal side is doing. And since higher rates right now have really boosted the fiscal side, I would say the fiscal side remains dominant. And what I think is going to happen, now getting back to where we're at with the Fed and their rate hike decision or rate cut decision, what I think is going to happen is we're likely going to start to see the major credit boom show up in economic data. So it wouldn't surprise me if the knock-on effect of the higher credit expansion and now this kind of booming credit cycle starts to actually kick CPI up to hotter than expected CPI prints, and then employment starts to stable. That is kind of the knock-on effect of the business cycle in terms of how it affects things like CPI and employment. So wouldn't surprise me at all if the second half of this year or by the end of this year we start to see a few surprises to the upside in terms of inflation and employment, or I should say to the downside for unemployment, and that then triggers the Fed to actually start to hint at rate hikes into 2025. I think that is a very distinct possibility if we do end up getting one cut in, that we then see some surprises on the backside of those cuts that then gets the Fed thinking, oh God, we got it wrong, we need to hike. And then that just perpetuates the current cycle that we were in or that we are currently in. So I do think that is a very likely outcome at this juncture. That is what I have for tonight, though. Like I said, if you're new here, get subscribed, turn the notification bell on, and apply to MMT.com if you want to take a look at the article that we had up. And then I think we just dropped a new article today as well, so check that out while you are there. All right, that's what I got for tonight. Good trading, everyone, and we'll talk to you next time. Bye-bye.